Welcome to the Gray Report. To start with a quote on today's episode, we've essentially never seen a quarter with larger rent cuts outside of recession periods. That was from Carl Whitaker speaking on the Denver multifamily market. And that paints a pretty gloomy picture of the U.S. multifamily market. But one thing we've learned that not every market is the same as the others. The national numbers compared to the markets and submarkets are a lot different. There's a lot of nuance today, not just multifamily, but the economy. And that's what we want to drill in on today. Again, focusing on some of this uncertainty. We've got federal government shutdown, which means maybe we're not going to get job numbers at the end of this week. We had a weak jobs report from ADP earlier in the week. Fortunately, Apartment List has posted numbers for September, so we'll be able to update some of our national findings and numbers. Are we entering in just a seasonally slow period? Are we on the tail end of a rolling recession and rolling now into recovery? We're going to try to paint a clearer picture, as we do every single week on the Gray Report. So if you're a multifamily investor, active, passive, you're somebody that's in the industry, you're in the right spot, because every single week we break down the latest research reports, the data on multifamily, housing, commercial real estate, and the macroeconomy to help us make some slightly more informed decisions. An exciting episode today. Got Griffin, Haddad from the investor relations desk here at Gray Capital. This guy used to work in the NFL. He made a career pivot. I'm going to ask him about that. He also has been just going deep into multifamily these last several years. He's the guy that put together this last newsletter, and he's doing a damn good job. So going to bring Griffin in here in a second. You're going to watch the whole episode of the Gray Report today. It's going to be a good one. Stick around. Let's do it. Welcome back to the Gray Report. Joining me as guest host on today's episode, Griffin Haddad. Griffin, how you doing? How you doing this week, today, this afternoon?
I'm awesome. It is October here in Indiana. Some would call that spooky season. For me, Spencer, it's vest season. So having a great Thursday morning here at Gray Capital. It has been an absolute pleasure to be in the office. This room's familiar to me, but it's a little different with these bright lights.
I was going to say, so we use the podcast studio. If you're if an investor at Gray Capital, or you've hopped on a call with the team, it may have been with Griffin here in this room. And a lot of times, I'm not saying that you just want to book with the investor relations team to get this view for yourself, but often we have folks that they come on a meeting and they think they're on a podcast. Mm-hmm. And no, it's a dual purpose room. Obviously, it's where we film the podcast, but it's a great video conferencing room as well. We've got all the nice AV equipment. So it's going to be a little bit different spot, talking through articles, talking about the market versus talking to investors. But first, Griffin, before we get into the reports, the first thing I want to get into is this new Apartment List report. Can you just do a quick introduction for the viewers and the listeners on who Griffin is? We're just quick background before later on the episode, I want to take a deep dive, but give us, 30 seconds.
Right. That seems fair. Griffin Haddad, investor relations here at Gray Capital. Past career in sports medicine. I'm a certified and licensed athletic trainer by education and trade. Spent 2 seasons of NCAA football in the Big Ten, then moved up to the NFL for 3 seasons. Had a bright awakening in my personal life that made me pivot in career paths. I found commercial real estate, and more than anything, I found multifamily syndication and Gray Capital. And my life has turned around. More involved with my family and my friends, as well as more passionate about my work life. So thank you for the opportunity, and it's awesome to be here.
No, it's a pleasure to have you on the team, Griffin. I mean, again, you bring a lot of value every single day here at Gray Capital. And again, some of the things that Griffin does that some of you may see, but some of the things that you may not see behind the scenes. I mean, Griffin has a lot of the inbound talking to new investors coming into the Gray Capital platform, also handling questions of existing investors, putting together our monthly reports, our quarterly reports. Griffin helps to put together our decks for our investments, helps on some of the marketing side with some of our research reports, some of that kind of assemblage and formatting. Create a creative guy, but also very personable. There's a lot of our business development also. So, Griffin's a big golfer, much bigger golfer than I am, or Blake, our head of investor relations. And so if there's ever a golf outing, Griffin is immediately recruited as he actually knows what he's doing.
Right. I think the craziest thing, Spencer, is that we've been doing this together, you and I, for 3 years now.
Yeah.
It doesn't seem like it's been that long, and 3 years is a relatively short period of time in the grand scheme of things. But looking back on my past career and that pivot to now have done this for 3 years, still have this imposter syndrome per se as I continue to learn and dive into the markets and the macroeconomic factors that are influencing our business. But to look back and see the 3 years of growth and better understanding of what we're doing at Gray Capital, the multifamily industry, the multifamily markets, it's been a heck of a ride. And I've learned so much, and I look forward to the next 3 years being part of your team.
Yeah, no, I appreciate that. It's exciting looking back at what we've done just over the last couple of years. But then, where we are in the market and, where we could take not just this company, but where the whole industry could go in the next couple of years is really exciting. And that's maybe a good transition before I want to go into more of your story later on. But I want to get to these market reports because I know that's what a lot of folks who are viewing and listening want us to get into. So Apartment List put out their September report. We always cover these Apartment List reports when they come out. They have great methodology, very transparent, some higher frequency data than some other sources. We look at every single source. We compare, we contrast, not just the actual numbers, but the methodologies. And let's just get to the headline. So the national median rent dipped by 0.4% in September, and it now stands on average of $1,394. This was the second consecutive month of month-over-month declines, and we have officially entered the rentals markets off season. But what's surprising is not that things are starting to slow down, is that they started really slowing down last month, and we had kind of declining rates of growth for every subsequent month, really since May. According to this, we really kind of peaked, really just in March, and then had declines ever since, really even April and May, depending which tracker. Some trackers have the rent was peaking kind of in May. Often that can be in July. Again, if you contrast this to previous years, which the most kind of pre-pandemic sort of normal year, if you can call it that, even though it was a year that we all thought maybe we were going into a recession, was back in 2019, where again, we had solid growth all the way through June, and even July was relatively solid. We almost want to remove. 2020 was a wild year, but then 2021 was insane in terms of rent growth. The last couple of years have been much more tepid, much more, the net has been on the downside. And to see a really strongly negative number in September does not help at least those national postings. Now, as we talked about earlier, the national numbers aren't the same as the local numbers. Griffin, you were just completing this week our monthly reports for our portfolio. At Gray Capital, we do monthly kind of property kind of snapshots where we update on NOI, rent growth, occupancy, a lot of like the key KPI trackers, and then we do a much more robust kind of write-up, full financial package on a quarterly basis. One thing you said to me that was interesting, and it's always good to hear, is our portfolio, we're positive rent growth across just about every asset, and then to see negative rent growth nationally, it's quite a big contrast.
Certainly is. There's a map at the bottom of this page. Maybe we'll get to it, but if you scroll all the way down there, all of the markets that Gray Capital is operating in, where our current portfolio sits, is in the red there, which in this case is a positive indicator of positive rent growth. Looking at our monthly reports for the month of August, throwing those together, I started to take a look at the month-over-month positive rent growth as well as the year-over-year positive rent growth, and our portfolio is quite healthy in regards to rent growth. More amazing and comparative to some of the larger, more national markets that have seen month-over-month, quarter-over-quarter, or year-over-year negative rent growth, the Midwest and our portfolio seems to be of the healthiest that I've seen, at least in some of the data. And then also just in talking to investors amidst capital raises and or just some catch-up calls, many of these investors are in projects or in deals or have portfolios that are in some of these markets where if we're projecting positive rent growth assumptions in our new acquisitions, there is a little bit of explaining that needs to be done and some data that needs to be shown, because the story and the headlines are, hey, negative rent growth month over month across the Sun Belt. National rent growth now has gone negative 2 months in a row. And so our investors see those headlines and they come to the Midwest where positive rent growth, it is happening. It's happening in our portfolio. So it's nice to be able to put data in front of them, and that's where our monthly reports come into play.
Yeah. Well, what is the biggest misconception when you're on the phone or on a Teams call with a prospective investor and they're not as familiar with the Midwest? Oftentimes they're getting in touch with us because they are familiar with the Midwest, and that's why they want to talk with us. But if someone they were referred to us, they don't exactly know where we are, they don't know anything about the Midwest.
Right.
How do those calls go sometimes?
A lot of the calls are, based in, I like the word discipline when we discuss our underwriting. I think a lot of people overuse the word conservative, but a lot of the verbiage I think that Blake and I are using is around the discipline that our underwriting model, installs and that we move forward with in our assumptions. And they'll take a look at anywhere from 2 to 5% rent growth projections across our model, and they will bring up portfolios or past deals. Let's use Austin for example, because I think it just entered as the softest rent growth market in the nation. Folks that have investments or deals in Austin will see our positive rent growth assumptions and just kind of, they're not floored and they're not dismissed, but they're certainly looking for explanation. And so I think when we talk to investors that are investing in markets where rent growth has been negative or is trending negative, the explanation of how we're able to see positive rent growth based on just overall lack of supply and the increase in demand from population growth. As long as you put those fundamentals in front of those investors, they typically will agree with us. It might take a few days or weeks to get them on board, but the data is there in the Midwest, and our portfolio shows that. So when we talk to individuals, whether it's a group or individuals, just bringing them in and showing them our current portfolio, it really speaks volumes, as well as just data from across the Midwest.
Yeah. Looking at this vacancy index, we've had vacancy inching up more and more, and we're kind of we are now have higher vacancy levels than we did pre-pandemic. This could be worrisome also, but it's a natural reaction or just result of delivering more supply than we have in over 45 years. So not too shocking. And if anything, just the fact that vacancy is kind of washed out to where it was pre-pandemic makes a little sense. Now, it would indicate, though, over time, there's some room to revert to the mean a little bit close to 5% or 6%, 5% in vacancy. But that is interesting that we're starting to peak out there. Again, just another way to look at median rent in the United States. So this is all bedrooms. We're looking at a graph here that's kind of got a little swiggly sine wave starting in as prices peaked in 2022 and has been oscillating downward ever since. I think the big question that folks have is the supply? Are we finished delivering supply? And are we going to see the pickup next year or in 2027? I've learned to be patient. My gut is 2027. And that's a gut. That's not necessarily, I'm throwing all the data. I do have data that's informing the decision. Do you have a feeling one way? Is 2026? Are we going to kind of be back to seeing rent growth? Or do you think that we've got more mud to wade through before we get to some growth again? What do you think, Griffin?
Just being ultra familiar with the Midwest, Indianapolis, seeing the supply being brought online here in Indianapolis, primarily on the north side.
Yeah, a lot of apartments building up in Carmel.
A lot of apartments on the north side of Indianapolis, specifically Carmel and Westfield. It does seem like the absorption, just from my personal observations, the absorption is there. There are a few assets that I've seen that maybe are slow to lease up. But in regards to the curtailing of supply, I would like to think that in the Midwest specifically, we're going to see positive rent growth continue quarter over quarter and year over year like it has in the past. Nationally, and talking with investors that are either living in Dallas or are from Dallas, invest in Dallas or in some of those Texas markets, it's incredible how many apartments that they've been able to build in the last 2 years. It seems like the urban sprawl and continued delivery of these assets is almost nonstop. And so nationally, hard to say if we're going to see positive rent growth, but it's markets like the Dallas and the Austin where if they do continually deliver supply, it would be hard to believe if national rent growth will turn positive.
Yeah. I think it's the difference between, absorbing, because I think you're right. I think a lot of these units are being absorbed, whether it's in the Midwest or if it's in Texas. I think the question is, they're being absorbed at what cost?
At what cost, yeah.
In terms of concessions, monetary concessions, or actually reducing that rental rate. Mm-hmm. And so, you may be, there certainly is absorption if we don't have any demand numbers, I think, in front of us today. But the demand and absorption rates are also at multi-decade highs. Most of the inventory is being absorbed. There's just a lot to absorb. And then what we're starting to see is, okay, the inventory is absorbed mostly through concessions. Now, how willing are those residents to either move into something else and to pay a higher rate that doesn't have that concession, or stay at that community without a concession and pay that higher rate? Is there going to be a lot of moving that goes around, because retention rates have been kind of near all-time highs, well above 50%. People haven't wanted to move. They didn't want to deal with moving. They didn't want to deal with the fear of maybe paying more, even though there's probably be more deals than most renters think that there are out there. So it'll be, I think the data is pointing towards a lot of pent up demand. It's just not pent up demand at any price. Everyone's very price conscious. And with some of the uncertainty revolving around the economy, people, I think, are watching their large financial decisions a little bit more closely and trying to be strategic. Seemingly they have to game the system. And whether that's on the decision of whether to rent, buy, or continuing to stay where they are and rent, or moving somewhere else and rent. People are really trying to make the right decision, but it doesn't seem like there's a lot of good options. I don't know. You're a social guy. Got a lot of friends. You're always hanging out. You're always doing something fun, Griffin. You're talking to people. You're at the age, though, well, your friends are getting married. But you've got friends kind of on either side of. Or correct me if I'm wrong. You got some friends. You got some single friends. You got some married friends. What's that conversation like? Renting, owning. Those are you see people who are going out and buying a house? Or are you seeing, again, these are all anecdotes, but they're all really interesting. Are you seeing folks push off some of those decisions? Are they waiting for interest rates to drop?
We're going to get to this a bit later, and I want to discuss with you today later on the podcast just the idea of affordability and home ownership.
Yeah.
I'm a new homeowner in the last 2 years. I bought a house that I can't afford, and there are so many elements of owning a house that I just don't think that the first-time home buyer truly is exposed to or is aware of. So in my conversations with my friends that do still currently rent, whether it's a single-family house, a duplex, or they live in a large-scale apartment community, a lot of the conversations are, let's talk about the actual affordability of that home that you're looking at in regards to the goods and services that surround your home that you're buying. Not only can you hopefully afford that down payment in the mortgage, but can you afford to take care of the lawn? Can you afford to maintain the fence? Can you afford to sweep the chimney?
I know some of the things that you've had to do to your house, and you've got a list.
It's a long list.
You bring in the log cabin restoration expert from out of state.
Correct. I bought a little bit of an older home, which it wouldn't trade it for the world. It's been spectacular, but going into that, I was not aware of or did not get told of some of the expenses that would be incurred across the years of home ownership. So the conversation with my buddies and their wives or their girlfriends, or some of them are still single living in a one-bedroom unit, is what does it really take to afford a house? And the idea of that really is looking beyond the down payment, looking beyond the mortgage payment, because those things are ultimately what's going to limit your ability to go out to dinner, limit your ability to buy that plane ticket, take a trip to see your friends, buy the concert ticket, all of the things that I think the younger generations are really jumping at, these experiences, music festivals. Those are the things that my buddies that are still renting are still interested in. Now, the friends that are having kids, that's a different story because they've started to slow down. They're a little bit more rooted to their home. Yeah. So that home affordability is now a different question. Can you now afford the childcare? What does that really look like? I think affordability is a kind of commonly it's a misconception of, hey, can you afford the down payment and the mortgage payment? But there's so much more that comes with it that I just don't think people are exposed to.
And if you just look at the down payment or just the mortgage payment on how that spread is wide, how wide that is, and you're not including the lawn care, the
insurance,
maybe the insurance, the hot water heater, the furnace, all the other stuff, all the maintenance, the roof, that gap widens even further, and most people don't think about that. And it's a big liability. Now, again, like you said, if you're making a long-term investment for your family, for your kids, it's okay. Maybe it's worth that stability, getting exactly what you want.
Right.
But that's not necessarily a cheap choice, and it's kind of a luxury.
Correct.
Also,
and you take a look at the Flats and Stones Crossing deal that we're getting ready to close on here in a couple of days. your rent payment gets you access to a fitness area, weight room,
Yeah.
a pool, all of these amenities that otherwise you wouldn't have if you bought the single family house. And now instead of spending time in the gym or at the pool, you're edging your flower beds, you're picking the weeds, and you're doing all these things that, I think is a privilege. But at the same point in time, I think a lot of these renters, they're realizing the value of what they're paying for.
Yeah. I think a lot about that also when we're putting these deals together. Specifically, talking about Flats of Stones Crossing, the deal we're getting ready to close down in Greenwood, Indiana. And, it's like, what are you missing? What are you missing living in an apartment versus living in your own home? And obviously, you're sharing walls. There's some things that are going to be innate. But like one thing that we've been trying to drill down in on for Flats is the amenities, and not just the amenities that are going to look good on the tour, but more like the practical stuff. How is it going to be used? And the one area that we focused on Flats is like these patio areas, and the idea that you want to be able to have friends or family over on the weekend and have a barbecue. Mm-hmm. It's a 292 unit property, 2 grills in the kind of the pool area. That's basically 2 families could have something on a Saturday or Sunday,
right? With the inability to know that, hey, if my buddies are going to come play cards and we want to grill out, that space is going to be available.
Yeah, there's no way to reserve it right now, and so we are first making all the grill spaces like reservable amenities. You can reserve it, but we're also going to install 2 to 3, trying to figure out exactly what we can make work within our budget. New patio grilling areas that are dispersed throughout the community that aren't just on one side.
Right.
That you can reserve. To say like, okay, look, maybe I'm not going to have my own little patio, but I still have access to one that may be nicer than the one that I could have had on my house, but I don't have to like worry about it all the time either. I need to clean it up after I've used it, but like that's it. Find it, should be good to go. Use it.
Just to tie that back into the negative rent growth story we were talking about earlier. I think in the Midwest, positive rent growth, whether it's 1 to 2, 3% organic rent growth that we've been seeing. If you start to add value, those rent bumps to the residents become a lot more palatable. Yeah. They're seeing where that money is actually going. They're actually receiving an elevation in the value what they're paying for. And so I think down at Flats of Stones Crossing specifically, our business plan does involve some rent bumps, but I think that we're not just relying on the rent growth of that property. We're also relying on the physical value add that we will be providing to get us to that level of rent.
And that can be a difficult, sometimes difficult to explain to a prospective investor, because you have organic rent growth, which is essentially if we don't do anything, the rents in the market will naturally increase by X percent.
Right.
Now, there will be some sites that organically the rents don't move by a penny. Others may move by 10, 15%, but the average might be 2, 3, 4, 5% rent growth. I love the way you put it, and I think it's the way that we look at it. It's a lot easier to move those rents if we show the value, improve the value, and we hear from residents in feedback that I don't mind if my rent goes up a little bit if you're making the place better. If I see what I'm going to be getting for my money for that rent bump, I'm all right with it. I'm happy to stay. It's when you don't do a good job, you don't take care of me, you don't fix anything, you don't add anything, and then you increase my rent. That's what rubs people the wrong way.
Right.
Now, it's all easier said than done, because if you're late to one service request, that can just leave a bad taste in somebody's mouth for the rest of their stay. And maybe, the maintenance technician quit the day before and you were just short staffed. Yeah. And you were late to change an air filter or switch out a light bulb. It probably didn't ruin the person's day, but again, perception can be reality, and you can't get everything right. But man, we certainly do try. Okay, just before we move on, let's just move on directly. We covered that quote from Carl Whitaker at the beginning about the Denver market, and I don't want to overemphasize that, but I think for me, it highlighted the unique slowness of this rental season. And again, it's just one market, one example, but it's an example of a market, Denver, that has been such a popular investment market for a lot of institutions for a variety of reasons that I couldn't exactly tell you, other than a lot of people have been moving there. Denver's a cool place, right?
It's a great
mountains.
city.
They legalized weed a while ago.
Right.
Like skiing. I like Denver. Love Colorado. Fishing, hunting, all kinds of cool stuff. I couldn't exactly tell you like the all of the drive. I mean, there's corporate headquarters, but they've got essentially negative population growth. This immigration story is not helping markets like Denver. Although if we go back to that apartment list map, I see a lot of kind of border towns that have really positive rent growth. So it's not necessarily the whole story, but they've suffered, some job losses. Today, job losses total about 4,000 jobs in the last 12 months, according to Carl's Post. And now supply is getting ready to fall off a cliff, he says. Fewer than 7,000 units are scheduled to deliver in the next 12 months. It's still a decent amount. Mm-hmm. But at the end of the day, it's brought on a significant amount of rent declines. And again, this is just one of those markets that was considered very safe from institutions. It was the Sun Belt, it was Texas, it was Florida, and then, Mountain West, Denver, then a little bit of Salt Lake City. These were kind of the darling childs of institutional investors. They just seemed very safe, very slick markets that I think, in a boardroom in New York City or Los Angeles or wherever, Denver sold really well to a lot of developers, and it was overbuilt. And just my observations over the last several years of this cycle is that there's a concentration of investment thesis. And it's an area that I think that people need to pay attention to for the future. One area of concern for me is preferred equity and private credit. Such an emphasis on that creates a huge amount of demand for dollars to be placed, because all of these institutional investors who represent a lot of money say, I need to place capital in these themes. People go out and look for deals. There's a shortage of deals. They start compromising on the quality of deals. We looked at a lot of preferred equity deals. Mm-hmm. We didn't do any. You know why?
They were all really unattractive.
They were all really unattractive. Could we have placed money? Like, sure. Yeah, we could have placed money into bad deals. Mm-hmm. So that's something that concerns me. I'm sure there's great deals in Denver that's going to recover, but it's an example of how different markets are, a Denver versus an Indianapolis, and then how great, seemingly good markets can be overinvested and driven down to where it's hard to make a business plan work when you are seeing that type of negative rent growth. All right. Now I want to move on. This is related to getting a mortgage. And you and I were having this conversation earlier of how the lay person talking about interest rates are interest rates, right? They'll go, well, the Fed just lowered rates, right? It's a good time to be in the housing market because I'm going to buy a house now. And they're going to lower rates again in October, and I might place my offer on my house then and time it with that Fed rate cut. They don't really have much to do with each other. Mm-hmm. At least not in the immediate time period. Here's a graph. This piece, Principal Asset Management, put out a piece. It was a very popular article on the Gray Report newsletter, which you can sign up at graycapitalllc.com/newsletter. The title is CRE in an Easing Cycle, Why Long Rates Matter More Than the Fed. We're talking about the 10-year Treasury, 5-year Treasury, 7-year Treasury, not really the 30-year Treasury. Mostly we're talking about the 10-year and how that really drives CRE valuations and decisions more so, certainly not exclusive from, but more so than Fed funds rate, really SOFR, the secured overnight financing rate. This is a chart comparing Fed funds rate and the 10-year Treasury. And what we can see is while the direction of travel can at times be similar, the trend is essentially moving in the same direction. They are not really correlated. One can be going down while the other one is going up. Mm-hmm. The 10-year and the longer dated maturities are market driven. There are buyers and sellers of these bonds that have to agree upon a yield that justifies the risk of the U.S. government debt, where the Fed funds rate is a completely fiat rate that is pinned by the Federal Open Market Committee, the Federal Reserve, and many other short-term loans are then indexed to Fed funds, or typically SOFR. SOFR and the Fed funds are essentially the same. And while longer-term fixed-rate debt, including many multifamily loans or 30-year fixed rate or mortgages, are fixed to the 10-year rate. You would think the 30-year home mortgages are fixed to the 30-year rate. It's not. It's the 10-year Treasury. So Griffin, I'm curious, when you added this article to the newsletter, what did you learn? What did you think? Any surprises?
This is a topic that again, I think there's a lot of first time homeowners, first time home buyers that are ignorant to this correlation. Again, you mentioned it just briefly previously. Fed's cutting rates, mortgages are going to be cheaper, more affordable. Not always the case. When I first saw this article, I think this spread between the Fed funds rate and the 10-year, often at its, the Fed funds rate's floor became quite stark to me. And the fact that if you are entering the market as a first-time home buyer or you're just entering into the commercial real estate space, watching the Fed, while it does correlate, it's not like you had mentioned, in a direct correlation. And so just better understanding what's actually driving our debt service payments, what's actually driving, our essentially NOI and ability to, outside of
At least our
control expenses,
cash
cash flow. What's important to watch? We're sit down all the time and watch the Fed minutes. We put it on the TV here in the office, whether they're raising or lowering rates. But at the end of the day, the focus should primarily be on the 10-year. So that was an exciting kind of realization for myself as I was watching the Fed funds rate drop or go up, trying to identify how that's going to impact our most recent deal or any future acquisitions. Now, with that being said, there is this kind of predicament, or not a predicament, the idea of, hey, in the future, as an operator of real estate across all the asset classes or sectors, that NOI growth should be the primary focus as compared to cap rate compression. And so my, question for you, as we are primarily cash flow focused investors, day one cash flow, what does this article and its highlighting the idea of NOI growth in the long term being more important than cap rate compression due to how we are operating gray capital in our current portfolio?
Yeah. Well, I mean, I think you said it first is we've always been cash flow focused, which means that we are more focused on existing in place NOI, net operating income, and then also where our business plan can take and trend that net operating income to translate to higher cash on cash, because we're looking for cash flow, investing whatever equity into the deal. We want some cash that's thrown off of that in place income. And that's just from our original goals and objectives. The qualities of this investment should be is one that delivers cash flow in a tax efficient way. So using the depreciation to shelter some of the ordinary income liability, that depreciation creates a loss that shelters the income. And so when you look at an actual net of tax yield, you're yielding higher than if you were investing in a product that with a fully taxable yield. 6% from a multifamily investment that is essentially tax shelter, that's a true 6% that you're going to be able to put in your pocket. Well, maybe that's only 4% if that was a taxable investment. And so looking at that tax sheltered cash flow as that primary driver is key. And we only are able to deliver that by two ways. One, buying it at a price where that cash flow already exists. We're not speculating that at some point in the future that cash flow will start, just because we want to start being paid from day one. We're okay with a little bit of speculation, but we want to limit the degree of speculation. We want it to be mostly upside. We can control that NOI growth to an extent. We cannot control cap rate compression. Now, there are things we can do strategically to maybe achieve a higher or a lower cap rate on our property at sale. An example for that would be leaving some quote unquote meat on the bone. So let's say we go in, we fix up a property, but we don't fix up everything. We fix up, let's say 50% of the units or 60% of the units to leave some additional growth for the next buyer. So when they go to do their underwrite, they can determine they can raise rents more, which allows them to pay a slightly higher price to us and achieve that same return. So the way that we're looking at, interest rates and cap rates is really for myself, it's to give an idea of a couple things. One, what is the longer term trajectory of cap rates in the market? We kind of want to have an idea of just where interest rates may be long term, and that gives us maybe an idea relatively of where cap rates are going to be. Again, there's never going to be, you're not going to see a one-to-one correlation, but again, it's like that direction of travel. If the longer term rates are generally trending lower, it's likely that you would see cap rates generally trending lower as well. Again, it's not going to be one for one. I mean, recently we've seen interest rates rise, including the longer term, maturities like the 10-year Treasury. It almost hit 5%. You could have if a one-to-one ratio existed, cap rates would all be up closer to 7%, at least 6.5 to 7%. We never really saw that though, because they stayed in a tighter band because there was still demand for those multifamily assets and a little bit of a discounting going on. Well, maybe we'll see some rent growth at some point, or hey, I don't think that interest rates are going to stay that high for forever, so cap rates remain kind of relatively subdued. They definitely rose, and so they didn't rise one-to-one, but they moved in that same direction. Now that interest rates have kind of come down, the 10-year Treasury is now hovering just above 4%. Cap rates have kind of stabilized, kind of hovering in a range anywhere, depending on the geography, depending on the type of deal, anywhere between 5 and 6%. They're plus or minus. It also indicates, interest rates can tell you a lot of things. They can tell you a lot about inflation. They can tell you a lot about risk appetite, and also just the perception of risk for the U.S. Financial system as well. So a lot of it. That's why the bond market, which seems really, really boring at times, they'll say that the bond market is where a lot of like the smart money is, which I don't always know if that's true or not. But bonds, there's a lot of information that is like packed in and interwoven into bonds, which is why, we're not just talking about property management or buying apartments or renovating apartments. We're taking a step back because a lot of folks that are watch the Gray Report are trying to decide, is now a good time to get into multifamily right now? Is it time to wait? What does the next 5 to 10 years look like? And so a lot of those outcomes are driven by, where maybe cap rates will be in 5 years. And while nobody knows that, having a little bit of an understanding of that direction of travel can at least give us the impression like we might understand it one day.
Right. With that past article on national rent growth, trending negative here in the last 2 months, this article placing an emphasis on NOI growth, double-edged sword between vacancy exposure in certain markets or assets and rent growth. How, as a decision maker and a multifamily operator and owner, how do you kind of solve that NOI growth problem at an asset that maybe is experiencing high vacancy rates, even amidst, I would say, healthy rent growth? I'll use our property in Evansville, for example. A lot of our rent growth, it is in renewals. Any kind of new leases or trade outs, it's right at zero, if not maybe just slightly below. We have some vacancy exposure with some healthy rent growth. Is it, talk me through that decision-making process on trying to solve for NOI growth across, year over year versus occupancy?
Yeah, it's a great question. I mean, with a really good specific example, because that's one where, depending on which KPI you're looking at, you could have come to a different conclusion about how we're doing. If you look at rent growth, I think we're doing really good. But if you look at our NOI, we're missing. And what that miss is mostly driven by occupancy. And so, we're leasing units at a good price, but we're not leasing enough units. And so part of it is, obviously, how do we drive more traffic? Do we have the right people in place? And we're looking at all of those things. But you can take different parts of the equation and get to the same NOI goal. You can be 90% occupied at a higher rent level and be achieving the same NOI than if you were at 100% occupied at a lower rent level. And there's a lot of operators, especially this year, have been wrestling with that, of saying, hey, okay, maybe we're not going to get the rent growth, but I'd rather be more fully occupied and have somebody paying something. Maybe I'm not getting that $1,500, but I'd rather get $1,000 than $0 and letting that unit sit stale and vacant, especially when you're going into the winter months, post peak leasing season. Not like we really had a strong leasing season, but like you shouldn't be expecting this time of year to start getting a lot of leases. Although, off topic, we are seeing some strange leasing activity now. We saw a little bit in September, and we're going to be seeing it in October now, which is really surprising. I think that's a story for another show. But it doesn't always come from rent growth. It's a combination of rent growth, occupancy, and then also your expense management.
Right.
Again, that's another area today when we're looking at NOI growth in an environment where there's not a revenue problem. We have strong revenue. We're getting strong rent growth. But at what cost? And literally, what is it costing us to get there? Because if we're spending more dollars than we're bringing in, it doesn't really matter. And so you're seeing a lot of flat NOI growth across the multifamily sector. It's insurance, it's property taxes, it's contract services, it's payroll, it's goods and services. It's a little bit of everything. That's why we've been taking. We've had an initiative over the last 2 years, but we've been really focused on how do we manage these assets for the next 5 or 10 years. Not how do we achieve the same results in a different environment. Doing the same thing isn't going to work. So how do we change our approach, because we're in a different environment, so we have to change to achieve success. And so it's technology, it's centralization, it's different tools, it's training, it's all that.
Right. It's all one big equation.
It is, and there's a lot of variables, and not every asset's the same either. Every market has
Correct.
a little bit different dynamics. This is an interesting chart. You pointed this out earlier, Griffin, and I think it underlines a lot of the issues with multifamily right now. And I think this is kind of crystallized in a moment of time, and it's not going to represent the longer term averages. But just again, looking at 2024 and 2025, it does show its long term averages. But apartments we're missing are that long term average and net operating income growth. Usually it's growing by around 2.5% a year, and we're growing by less than that. The only two worst sectors are office and self-storage, which are both negative. Which self-storage being so negative, I knew self-storage was struggling because it was an asset class that I think was overinvested in a little bit. And I think there's a little bit of a post-pandemic deflation coming out that no one really thought was possible in this sector. But anything else stand out to you on this graph, Griffin, looking at just some of this? Because there's some sectors that are really growing.
So let's just remove office and self-storage, and I'm not sure it's fair, but they're negative to begin with in 24.
Yeah.
Looking at, so now there's 10 asset classes or sectors up there. If we remove office and self-storage, that leaves us with 8. Of those 8 sectors that were positive in 24, there's only 3 sectors that have grown year over year from 24 to 25 in regards to NOI growth or exceeded 24, and that's healthcare, data centers, and shopping or manufactured homes.
Yeah.
And I just thought that was interesting that there's only 3 asset classes that are performing better this year than they have in 2024.
Yeah. Data center is the buzzword. It's it's growing in popularity, and it's one of those theses that spooks me a little bit because there's so much appetite to it. Every investment manager, every wealth manager, every RIA is like, we're getting into data centers.
It's trendy right now. It's a buzzword at this point. I'm sure there were some early movers that are, realizing incredible multiples and gains and are well positioned. But currently, if you take a look at, all of the offerings across private equity or, whatever it might be, somebody's got a data center, or it seems like everybody has a data center offering.
Yeah. Yeah. Now, healthcare, healthcare is a pretty wide sector. I'm not sure if they're talking about medical office or what type of healthcare, but it's interesting to see for sure.
From an investor perspective, if you're invested across asset classes, whether it's industrial, retail, apartments, and you're looking at year-over-year performance, and you're looking at a Gray Capital project or another sponsor project that may be performing or underperforming compared to last year, I think this is a fairly good indication of, it's maybe not just that asset class, but it's a commercial real estate wide at this point with the exclusion of the data centers and healthcare.
Yeah. Yeah. And also, I think, we're closer to a trough in the market, we're in general CRE sectors. I think certainly, office has been the trough. I think apartments kind of been around a trough. Most of these industries have some related to supply, some related to valuations, interest rates, and it'll be interesting to track these levels as time goes on.
Correct. Just taking a look at the, office, I think the primary causation of 2024 underperformance would have been occupancy versus, apartments in 2025. Is it an occupancy or is it rising expenses? Like we mentioned, it's a pretty complicated equation with a lot of variables. It would just be interesting to maybe dive into what's causing maybe some of the sluggish performance across 25 in a lot of these asset classes.
Yeah. Well, on to housing. Share of mortgages with rates above 6% climbs to a 10-year high as Americans adapt to new normal. This is going back to our conversation related to affordability of housing. And it looks like, we've exited the period of where houses are less affordable in the short term and where they used to be. This is kind of becoming the new normal. And this is where it starts developing. I think this is on one of the silver linings, positive stories. It doesn't seem necessarily positive on the onset, but it's positive from a rent growth story in multifamily and in apartment demand. Because while some homeowners are going to be able to get assistance from their parents to buy a home, some are going to be doing really well in their 30s and have the money to buy a house. A lot of people aren't. They're not going to have that support. They're not going to have that good a job now. But 10 years ago, they might have still be able to afford a starter home, but probably not today.
I talk about this a lot with my parents.
Yeah,
Wouldn't say a lot. It gets mentioned.
yeah,
just in discussion of interest rates and relatively, the cost of capital. My parents, other parents, grandparents that I've talked to, they say, 5-6% interest rate, that's nothing. When I first bought my first house, I had a 12% interest rate. Well, the asset values, the home values at that point in time were way below where they are now. And so you're buying a starter home at $200,000, maybe less, paying a 12% interest rate on, $180,000 versus today's starter home that are $500,000 at a 6% interest rate. It just, again, relative affordability comparative to historical past, it's a little bit different. Then you include all of the inflation and expenses for goods and services. I feel like home ownership really has never been more unachievable. And then you want to throw in their wage growth, across the younger generation. That's a different conversation. But there's a large gap between wage growth and the overall, growth in home values.
Yeah. Well, moving away from housing a little bit, on to more macro economy. We're in a government shutdown. We're just going to start with that. So the government shut down, the federal government. It seems to some people like this is the first time this ever happened. I guess it's been the first time in 7 years. Government shuts down every once in a while. Everything gets put back together. Now there's a lot of threats. Everyone always threatens everybody. The national parks will eventually shut things down to make everyone feel like there's a shutdown going on. The government being shut down isn't a good thing. But one thing that impacted certainly our week is that we're not going to get as much economic data, apparently, until the government reopens. And the big piece of data that we were all looking forward to is employment numbers this Friday. Now, ADP, which is obviously a private payroll provider, puts out their own employment report, typically a couple days prior, same week that the national report from the BLS comes out. Now, we could all say, as we've talked about on this podcast multiple times, it's been talked about in the national press, these BLS numbers are not that great in terms of accuracy. They were just revised down by 900,000 just a couple weeks ago. So, what are we really missing? I'm not too sure, other than that is the data that we've used, and it's the same consistently incorrect data that we're using to make decisions, which should lead to more questions of why we're using the data and how we're getting the data. But nonetheless, ADP, just to get into it, ADP came out with their report of a negative 32,000 jobs added. So not added, 32,000 jobs lost in September. The estimate was closer to 43,000. And so that's like a 70,000 job swing. Thought it was going to be positive. It went negative. And we don't have any other data to kind of counter this. Again, usually later on in the week, on Friday, it would come back that we had positive 50,000 jobs. And most market participants would say, well, screw the ADP report. Let's look at the BLS report because it's from the Ministry of Truth over at the government. Well, now we don't have the Ministry of the Truth telling us something that's not accurate. And then the reason why we're paying attention to this is because, one, we're all trying to figure out what the heck's going on in this economy and what the FOMC is going to do later on this month when they have to decide whether they're going to lower the Fed funds rate again or not. Because you know what else is going on today, Griffin, over the last couple of days? Stock market, all-time high. Gold, all-time high. So we've got markets at all-time high. We've got some areas of the economy that appear to be heating up. A lot of it's driven by, Mag 7, AI, data centers, AI, productivity boom. But we know, manufacturing though, it's been contracting. So PMI came out.
Right. I looked at that this morning.
Looked at this morning. PMI, what I think 48, percent or whatever, which basically it's been contracting for the last 9 months. That's the manufacturing index. And it was Griffin and I were having a conversation about, all these reports and he's putting more of these reports together and, what they all mean and how contradictory parts of the economy is. And part of me thinks that that's okay. If everything is going in one direction, there's a higher degree of potential, a bubble or over exuberance. And that's where you can really get ahead of your skis. We need some things to be going up, some things to be coming down, to be a little bit more imbalanced. And it makes me feel a little bit better also that we're not going to see just inflation spiral outside of control. Because how can it if we're losing 32,000 jobs and if manufacturing is contracting? Well, okay, maybe we have some price pressure from tariffs, so we all agree that that's relatively short term. Maybe we have, some mispriced assets related to AI because they're overvalued, but a lot of growth prospects. Putting it all together. Do you think we're in a recession, Griffin? Do you think we're far away from a recession? What do you feel about the economy?
I got an email this
morning.
What do you feel? From it's an RIA that commonly produces newsletters. They came out with an email today that says what to do when the market hits an all-time high. And it seems like it's been more common recently, in the last 2 years. The first sentence was, don't panic. Because I think the idea of markets hitting all-time high, sell. I'm sure they're getting emails, phone calls. I need out of X% of my position here, and here. And the idea is let's realize gains while we can. I feel like when you watch something continue to climb, the correction has to come. Whether we're in a recession currently or not, unbeknownst to me, but I do think that taking a look at all of the growth in the economy really over the last year and a half, there has to be some type of pullback. And I could be totally wrong, but I've just seen, studied, heard, listened to enough advice in regards to the equity markets that everything kind of reverts back to the mean. And so with all of this growth, I would just be curious to know as what type of event is going to have to cause that, because it just seems like with so much uncertainty, with some of this, fear mongering or panic in the market when it does reach an all-time high, what has to occur to really kind of draw that back? And the recessionary event is really kind of the only thing I think of.
Well, so let me ask you this though. So you're talking about equity markets,
right?
And I think that can be a disconnect also. And I also, misled a little bit talking about, the stock markets. These things are at all-time high, but the stock market isn't the economy.
No, it's only one small portion of it.
It's really only one small portion of it. Most businesses are private. More businesses are private today than they ever have been, not for all time, but in modern history. And so, we just talked about manufacturing slowing down. We have jobs coming down, and so the correction we could have a correction in the stock market and not be in a recession. We could, probably not a crash of the stock market, but we certainly could have a strong pullback. I mean, we had a strong pullback, earlier this year.
Right.
Once, tariff, basically post-election and tariffs got announced and Liberation Day,
right.
We had a huge pullback. And given the valuations of a lot of public equities, some sort of pullback, I think, makes sense. Whether that drives a recession, I guess I'm less.
Less concerned about the equities market's impact. You're more
Well,
focused on some
I
of
don't
the
know if.
macroeconomic factors.
Yeah,
How
well,
many?
I'm. It's more. I don't know if we haven't already been some kind of recession that doesn't meet the definition of recession.
Right.
But I feel that we've been in going through an economic period that we just don't have the proper words to describe. I feel like we have very few words to describe macroeconomic conditions: recession, recovery, boom,
Right.
bubble, stagflation. Very few others. And when some parts of the economy are seeing extreme growth, like AI, that could have long term growth prospects to improve the whole of the economy, that could be bigger than the internet, that create an immense amount of wealth and efficiencies and increase productivity, which can allow you to take on more debt and grow without necessarily causing inflation. You can also have some other parts of the economy that are look like essentially they're in a recession or doing not as well. Real estate is one of those. Real estate has not been doing well the last couple of years. We've been finding a way, niches. There's always opportunities to make money in every market, but the sector itself, on average, has not been doing that well. People have been losing money. People have been going through foreclosures. Manufacturing, similarly, not been doing nearly as well. There's more investment that's going into manufacturing, but it doesn't mean necessarily it's growing by leaps and bounds in terms of production. So, I say all that is that are we going to hit a recession right away, or have we kind of been in something that's like a recession?
We've just been living in it for the last 6 months to a year, and just haven't
2 years.
2 years, and just haven't
It's 23.
haven't seen the dramatic impact. So it's somewhere in between the recession and normalcy.
Yeah, I mean, what we haven't seen is the job losses. We haven't seen the job losses that you would typically see in a recession, and we're starting to see obviously job numbers come down.
Right.
And we've seen GDP that's been a little bit all over the board. We did have 2 negative quarters of GDP growth back in 2022. Those weren't counted as a recession.
That's the standard definition, correct? Of just 2 quarters.
Yeah, but there's more to it than that.
Okay.
Like the conference board ends up making the call, and there were reasons why they decided that was not a recession.
Got it.
Government spending also significantly contributes to GDP. During the Biden administration, so we had stronger GDP than maybe otherwise would have if if the federal government wasn't spending as much money right now. And then earlier this year we had a huge drop in GDP because people were importing. So like when you're importing things, like it lowers GDP, somewhat artificially. So this all brings about uncertainty. And going back to the government shutdown, it doesn't allow people to make decisions, large financial decisions, which I think is keeping a lot of investors on the sidelines. It's also keeping some folks from moving, going back just to apartments. A lot of people just aren't deciding to move because they're not sure about the underlying economy. It's fascinating. But, we're a little bit stuck in Groundhog Day also, because around this time last year, we were expecting interest rates to come down, to survive until 25.
Right.
And now we're in Q4 of 2025.
Unbelievable in its own right.
Really, really is. Well, now we've gotten through a lot of the stories, and again, you can get all these articles, these reports, and all the latest research reports and data that involves multifamily industry, commercial real estate, in the Gray Report newsletter. Hop on over to graycapitalllc.com/newsletter to sign up. It comes out every Thursday at 8:30 in the morning Eastern. Griffin, I want to talk more about your story. So, prior to joining Gray Capital, you were in sports medicine. What got you into sports medicine? And tell us, what got you into sports medicine, and how did you find yourself living up in Green Bay, Wisconsin?
Right. Yeah. Expedite the story. High school baseball player. Had some significant soft tissue injuries playing high school baseball. Got exposed to surgery, rehab, And then the profession of athletic training, our high school, had an athletic trainer on staff. So you go see him or her every day, you run through some exercises, and more than anything, you kind of get to know somebody during that time period. It was my first exposure to what an athletic trainer's roles, responsibilities were on a daily basis. But at that time, I didn't notice it. It wasn't something that I was keen to or very focused in on. I was just trying to get out of that room as quick as I could and back to the baseball field so I could be with my friends playing baseball. Got time to like, hey, you should go to college. And you're right, you should go to college. Well, what do you want to study? I think probably like a vast majority of, 18, 17-year-old kids, I had no idea, but I did know that I wanted to get out of the state of Indiana. So I ran down to the south where I thought, hey, that'd be a lot of fun. Let's go check out some campuses. I found Texas Christian University, TCU, Go Frogs, where they had a sports science and a sports psychology department that I was interested in. I just wanted to kind of feel out what that was. And so when I first got on campus at TCU, I had no major, but I was on the track to enter into sports science and sports psychology my second semester. During my first semester, I ran into an individual on campus that was studying athletic training, sports medicine. And he introduced me to the professor, walked me through a couple of their clinical sites, which is the athletic training room on campus. Realized, hey, this is exactly what I want to do. I really like this. You feel like you're a part of a larger goal orientation. You get individual one-on-one time with your patients. And then there's also some type of reward at the end as that individual gets to go back to return to sport. So studied that for 4 years and then got given a really awesome opportunity to run up to Ann Arbor, Michigan. I got to work with their football program for 2 years as a graduate assistant athletic trainer. From there, I got basically told, hey, son, if you want to do this at a high level, you need to go and obtain an internship in the NFL. I got given an opportunity to make my own decision, which was really great. Not a lot of folks have that opportunity to make a decision between teams. I chose Green Bay. I really like the staff up there as well.
What's that process like? You're just saying you get to choose, not everyone gets to choose.
Right.
So, what's that? You go to the NFL and
they run a big nationwide internship search.
Okay.
They have
the whole NFL does.
The whole NFL. There's 32 teams. Typically, there's 2 seasonal interns for an NFL team. So there's 64 seasonal interns each year. There's also summer interns, anywhere from 5 to 10 summer interns. The summer interns are more undergraduate students, where the seasonal interns are entry-level professionals.
Got it.
So at that time, I was seeking a seasonal internship, and you apply and you get accepted. They kind of just say, hey, you're going to go to the Cleveland Browns, or hey, you're coming to Indianapolis Colts. You can apply to each team directly, but you should really just apply to all 32 because it gives you the opportunity to potentially land the spot. I was fortunate enough in my connections at Michigan. The head athletic trainer at the University of Michigan for the football program had just come from the New England Patriots. His connections in the NFL, he basically just called around and handed me that opportunity, but he told me I could choose between 3 or 4 teams, of which I chose the Green Bay Packers. So I wound up in Green Bay. I was 25 years old, moving to Green Bay, Wisconsin, as a seasonal intern for my first year. That was a kind of eyes wide open, soak up and absorb whatever you can, and don't say no to anything that is put on your plate.
I know you like football, but you always thought you were going to be working in football because you said you play baseball,
right?
So obviously you were down in Texas. Football's big in Texas, but did you always think it was going to be football? But was that just the path to get into? If you want to do this at the highest level,
right.
The highest level is practiced at the NFL?
The highest level, in my opinion, and I would say that there's quite a few professionals that would say the same thing, just based on the full contact nature of the sport.
Makes sense.
There is a spectrum of conditions, events that you need to be prepared for and ready for and capable to handle. If you work football, that's in high school. That's in, they go to these like arena leagues these days. If you work football, you're well-rounded in all aspects of emergency medicine, as well as just the musculoskeletal system and the rehab of those injuries. Coming out of undergrad at TCU, I thought that I wanted to work in the NCAA. I was 24? 23. So, you're around kids that are like your same age. You're creating relationships, you're meeting people. That was my initial goal. And so I got to Michigan, and that opportunity was just with their football program, which was a very unique opportunity. A lot of times if you go to the university setting on a graduate assistantship or an intern, you kind of get spread thin across all the sports that maybe not nobody wants to work, but let's just say
You're doing a field hockey.
swimming and diving, field hockey.
Yeah, Blake, swimming and diving.
Right. Yeah,
He's doing
Blake. Cheerleading would be one of those
Yeah.
things that the graduate assistant would usually oversee.
The worst things.
My role was specifically within football. And so I started kind of building a resume or just an experience, kind of rap sheet that led me down the path of pursuing football. Not to mention in athletic training and sports medicine, the most money is made in football at the professional level. And so knowing that, I kind of continued on that path. Didn't play football growing up. Really don't have much of an interest in the overall strategy of the game, but it was something that at that level in the NFL and the NCAA, I really needed to understand. And there's a lot of reasons for that, but primarily if you're a wide receiver and you get hurt, I need to understand the demands of your position in order to get you back to playing at the level upon which you're getting paid to play.
Yeah.
So I had to get really intimate with the strategies and the techniques of the game of football, but also each position. So I kind of began to love football through that role, and just really kind of get to understand what it means to perform at that level in that specific position.
So you go from working up in Ann Arbor, University of Michigan, you go to Green Bay, Wisconsin, start working for the Packers. What is that like, that transition from collegiate sports, which is very high level, but then you're you're working at the NFL.
Yeah.
Again, highest level of your specialty, but
craft.
also a unique, from a little what I've heard and what most people know about the Green Bay Packers, that's a unique franchise in itself. And you're in a unique market, not the largest market by any means.
No.
So there's a lot of variables. It would have been a lot different if you were, with the LA Rams or something like that in a big market, different organization. So just what was all that like in that experience?
Right. I continued to just kind of get lucky in my timing. The Michigan thing worked out. Going to Green Bay worked out. Following my first year in Green Bay as that intern, there was an senior individual on staff that retired. I knew that going into my intern year that he was going to be leaving. So it was essentially a living, breathing interview. It wasn't anything that they were, holding us under a microscope. But most seasonal interns, you're there for 9 to 12 months. Some seasonal interns will serve for 2 years. At the tail end of my seasonal internship, I got asked to apply for that position, which I thought was timely. I had, kind of searched far and wide in college football for a job at, I would say more low-level schools, jobs that I thought that I was qualified for. Definitely didn't think I was qualified to be now a full-time member of the Green Bay Packers athletic training staff. Ended up getting that opportunity to come on their staff full-time, which was really remarkable. You get there as an intern, or I got there as an intern, and you're trying not to get too, wide-eyed at the bright lights and the guys that you grew up watching playing football, and you're only going to be there for 9 months, and so you're trying not to become immersed in the culture or be enamored by the history. Once I got that full-time job, that all kind of set in. I say this all the time, but when I was at Michigan, they just handed me a key ring of keys, and I had keys to the gate at the Big House in Ann Arbor, which is one of the largest stadiums in the world. I could go in there on any given morning.
Isn't that amazing how colleges will do that?
It's unbelievable.
When I was in the music school, I got a key ring to basically every
not
every door in the music school, but I'm like, you really going to trust us?
Right.
These keys?
These guys didn't. They didn't even. I mean, they knew my name. They knew where I was coming from. But here's the keys to Michigan's Big House. It was crazy. So same thing in Green Bay as an intern. My little swipe card could get me a lot of places, but finally I got access to essentially there was no door I couldn't open as a emergency medically trained
you got to
individual.
get in.
So I could get on top of the scoreboard up in Green Bay. And I remember the first time I went up there, it was like 2 or 3 days after I got the full-time job offer. I was all by myself, and I just sat up there, and I was like, this is essentially what I've been waiting for, what I've worked so dang hard for over the years, was to, one, be involved in a team-oriented atmosphere where everybody's after the same
working at that level.
Right.
Yeah.
And one of my criteria when I was looking for jobs is I wanted to work somewhere and put all that time, energy, and effort to a product that people actually cared about. Went to a high school here in Indianapolis. You go out to the football games, they're attended. There's not a whole lot of people there, but that was something that I wasn't going to sign myself up for. I wanted to walk into a jam-packed full stadium where the games were on television and people really cared about what was going on, the wins and the losses, the performance of the players. I wanted to be a part of something like that. So I was up on that scoreboard, and it kind of all set in. And that was the moment where I was like, wow, I've really achieved my dream job. I've landed where I'm supposed to be. And then we can fast forward essentially 2 years.
How did that feel?
Awesome. Super cool. I mean, in the world of athletic training, you can work in a lot of different settings. There's individuals that work in Las Vegas with Cirque du Soleil. There's individuals that are, medics in the Army.
Mm-hmm.
There are people that work in the Amazon factories over ergonomics, and they're trained, licensed, certified athletic trainers. I chose the path of
the Amazon PA didn't interest you. That path working in the
that
facility.
Is a well-paid, big benefits position.
Yeah.
But at the end of the day, you're working with, they call it kyphosis of the spine, of people bending over to, you're working with individuals that have, essentially like compression or smash injuries of packages, or getting their hand stuck in the roller, or, bursitis of their elbow, or just kind of these very mundane pathologies that, are rather unexciting. You're in a warehouse every day. It just wasn't the setting for me. Now, there's people that I know that work at the Amazon warehouse. I love it. I think it's awesome.
Yeah.
But for me, I wanted to have the fast-paced, high-stakes atmosphere of professional sports. And I achieved that, and I got there, and I enjoyed the heck out of it. I mean, I've got really awesome memories. I met some really cool people. I can tell stories for hours, whether it's about Coach Jim Harbaugh at the University of Michigan and his, kind of off-tilt, persona and how he operates in the world versus, hanging out with Coach Mike McCarthy in his last year in Green Bay back in the intern office, and him just chatting it up because he knew the media was waiting for him outside the stadium, and that was a safe place. I have so many stories.
What some of the stories that you've told me that are interesting is just about some of the personalities, and you can name drop or not.
Right.
Some folks are really humble and seem like really just good, genuine people. That's who they are, and some people let it go to their head. And it's sports, it's business, but just walk us through just, I guess, some of the lessons learned of the different personalities that are out there.
Right. So one of the coolest things that happened to me when I got to Green Bay, my second year we were there, we drafted a middle linebacker from TCU that I'd worked with previously.
Okay.
He was a freshman. I was a senior. And I had been up to Michigan and then over to Green Bay, and he shows up and it's like, hey, like, super good to see you. This is incredible. And there was this mutual respect of, you've reached the pinnacle of your craft and I've reached the pinnacle of my craft. It's really awesome to meet here at the pinnacle.
Yeah.
And we worked together for 2 years in Green Bay, and that was phenomenal. He was an outgoing human being, family man, super awesome to me, nothing but nice, was respectful of my time. Didn't just walk in. It was not transactional. If we're going to be working on something that day, doing rehab or soft tissue or injury prevention, the conversation was never, hey, I need this. It was, hey, Griffin, how are you doing today? What's going on in your world? When was the last time you talked to your parents?
Yeah.
You got any friends coming to town soon? Oh, hey, by the way, since I'm in here, I was wondering if you could help me out with X, Y, Z. Then there's the other, side of that spectrum where they come in, whether it is, whoever it was with their big headphones on, and they got their, iPad, and they're watching whatever they're watching. It's definitely not game film. It's some kind of, comedy stand up, or they're listening to music, and they don't even look you in the eyes. They just mouth to you, hey, need some Advil and I need this treatment. And it's like, all right, have a seat on the table. If you treat me with that level of, hey, I don't see you, you're just a service to me because I got to this level. My attitude never changed, but it did kind of wear on me over time.
Yeah.
And it's a small patient population that is at that level that behaves like that. And so it shouldn't be me spreading that the whole NFL is like that, but there are these individuals that were really kind of sour and will ruin your day. And that was the point in time where, hey, I get it. You're here. This is your job. You need to check the box of morning treatment this morning. And we're certainly going to be productive in here, whether you want to be or not, because it's my job to ensure that you're doing what you need to do to get back on the playing field. But there was a level of interest and a level of respect that was just below threshold for me and some individuals. And it just became one of those things where you had to bite your tongue and you just had to deal with it, where I feel like now in my personal life, and maybe it's professional life here as well, where we have the opportunity to choose who we partner with. And so if there's a relationship that we don't think is going to be beneficial or mutually beneficial, we can kind of cut the ties and not welcome somebody into our atmosphere. Whereas there, I didn't have a choice.
Yeah. Good vibes only.
Good vibes only is correct. Yeah.
So, so then let's just fast forward a little bit to where you get to the point of where you kind of you're peaking out of your career, or the pinnacle of your career, working in that environment. At what point do you get to a point where you start thinking about maybe this isn't your long term, what you're going to be doing the rest of your life, which is what you had probably thought a couple,
Right.
moments ago.
It was seemingly overnight. I woke up one morning and felt like I just had this awakening, this epiphany, but that isn't really true. When I was at Michigan, there's a staff member on their medical staff that's still there today. He's a good friend of mine. I was a graduate assistant getting absolutely buried in my master's schoolwork, but also working full time for the football program. And we talked basically weekly on the longevity of this career and what could possibly be next. What can we enter into that is, an easy transition to get us out of the obligation and the burden of being intimately embedded into this football team. Years went by and I'm with the Packers, and I woke up one morning. It was during the pandemic where we were, sequestered, not allowed to see family or friends. There were a lot of outside influences that I think expedited this feeling that I was having. I think it was always there. It was always an idea, but the pressures of the pandemic and some of the sacrifices that we were forced to make as a medical staff and the role that we got cast into really magnified a lot of those feelings. So I woke up one morning without a plan, walked into my boss's office, and it's not this simple, but essentially just told him that, hey, this is no longer for me. I really appreciate this opportunity. And I think I did this in a really tasteful and really respectful way. It wasn't just like I walked in and said goodbye. It was, well presented, and I didn't need to justify myself, but I thought that I did that. But I woke up one day and I just realized, hey, this is a really cool job. I really like what I'm doing. Matter of fact, I love what I'm doing. But outside of work, there's nothing else for me in Green Bay. I don't have a wife. I don't have a girlfriend. I'm unable to see my parents. I can't be a son. I can't be a brother. I can't be the uncle. I can't be a friend. I am just an athletic trainer here in Green Bay. And I started looking around at, other people in the profession, not just in Green Bay, but other athletic trainers, realizing that, if I continue down this path, this is going to be the result. And I'm watching, folks not be able to pick their kids up from soccer. I'm watching, dads having to stream concerts that their kids are playing in on the computer rather than being in person. And it's just a few minutes down the road. I thought to myself, hey, that wasn't the goal that I set out for in my life. It's the goal to achieve this career, but it's even bigger goal to achieve this in my personal life. So I kind of woke up one day and I said, hey, let's try to love my life a little bit more and love my job a little bit less. Yeah. And I say that in front of you, not that I love this job less than Green Bay, but what this job has done for me has opened up so much more ability to really kind of come into my soul, who Griffin Haddad is, outside of work. Since leaving Green Bay, I think this maybe would have happened in Green Bay, just at a slower pace. I now own 2 homes in Indianapolis. I got married. I inherited a dog. I see my parents many, many, many times a week, both my mom and my dad. My brother's in town this weekend. He's got 2 little girls, able to be a brother to my brothers, an uncle to my nieces, a son to my parents, and a friend to my friends. Also, a productive employee of a really awesome company.
Yeah. Well, appreciate that. But it's you did that.
Right.
And most people don't make the pivot or shift when they see that they're on a track they might not enjoy. Some people don't even think long term of what does this look like if I stay on this track, and to see it and may take a decisive action, which is not easy, to go into that office and have that conversation. And I know we've had longer conversations. You've gone into more detail with me about it, and no, that wasn't easy. Wasn't as smooth as you thought it was going to be, because everyone think you should be so honored to even have that position in the first place, and a little bit of how dare you, right?
Right. Yeah. The idea is, there's always somebody behind it that'll come and do it for, 10 grand less a year, or maybe even more. And, nobody's irreplaceable, but in that world, you see it from the players. They'll cut those guys like it's a business transaction, and that's what it is. Now, the Packers culture was great. The GM was awesome. The medical staff was nothing but great to me. That organization is top class. But at the end of the day, if for some reason you begin to trip and fall and stutter, they will move on from you pretty quickly. And they'll do it with pretty much no remorse. And the idea of spending all the time, making all the sacrifices, and I don't want to sound like I'm complaining, but there was one point in time when I started getting fed up with it. There were 221 days in a row where I had to report to work. Some of those days were 4-hour days, and I was on the golf course by noon. We started at 6 a.m. and I'd be on the golf course at noon.
Still 221 days.
Those are rare.
Yeah.
Most of the days are 13, 14-hour long days where, we're, if not the first person in the building, we're dang close. And if we're not the last person to leave, there's something weird going on that day. And so it just was one of those things where it's like, hey, I'm working way too dang hard to not have the freedom and the ability to go to, weddings, birthday parties, funerals, family reunions, vacations. I'm working way too dang hard not to have a personal identity and not to be able to fulfill the roles that I think are of the utmost importance in life outside of this job that I have. So it was a really awesome kind of awakening. There's two people in this world. There's two types of people. One person will sit there and say, well, you left the Packers? How could you do that? You must have been making so much money. I can't believe you left. And then there's another person that will sit here and they'll listen to me and they'll commend me for making a mature decision that was in my best interest and not anybody else's. And it's the people that listen that I have an immense amount of respect for and I appreciate. There's the people that will scoff and say, I can't believe you did that. That conversation's over right then and there. You'll never see it from my perspective, and it's not worth me sharing my story.
I mean, I can just all the times I've talked to you, and I'm sure there are moments where it's like there's a cool part of that job or that lifestyle. And I didn't really know you that I didn't. I think I know who you were back when you worked in the Packers. But you mentioned we went to the same high school. You're a couple years younger than me, but you and my sister-in-law, you guys in the same class.
Right? We are, yeah.
And but you seem to have able to have a little bit more balance. And again, didn't really know you back then, but just the way that you speak about it. You don't have a lot of regrets.
No, haven't second guessed it for a single second. The most beautiful thing, there's two sides to this. My sister-in-law is intimately embedded into the NFL as a dietitian in the league. So she's in it. She's living that day-to-day operations that I was a part of. And she absolutely loves it. She's in a different market. She's surrounded by friends and family. It makes a lot of sense. She talks all the time about how enthusiastic she is about her job. And I'm kind of on the other side of like, wow, I love that you love it.
Yeah.
But take a look at some of the things that maybe you're missing out on outside of the facility. And one day it'll click, and that's fine. As long as she loves it right now, I can totally support her. But then I also have an older brother who's intimately embedded in the Major League Baseball system. This past season, he lost his job. The team he was working for let him go back in May. He's had a full summer to be dad to his two girls and a husband to his wife. And as the postseason begins here in Major League Baseball, he's kind of getting phone calls and text messages and connecting with teams that are looking to bring on new staff. And he's now kind of having the same tug of war of do I go back into that arena, enter back into that time suck and sacrifice, pulls me away from my girls and my wife, or do I go and pivot and do something else that maybe frees him up to be who he is currently for his girls and his wife. So he's kind of in this tug of war. And so it's fun to have that discussion with him on somewhat of a surface level. He doesn't have the details yet because he was really my sounding board when I was making my pivot, because he not only understood what the environment and the demand of professional sports was like, but he also saw the athletic trainer across Major League Baseball organizations, how overworked they were, how undercompensated they were, and just the general level of respect for that career. He was really the catalyst to me saying, hey, I think I'm going to quit my job. I'm going to leave Green Bay, but I can't do it. I have nothing else. Yeah. He goes, you don't need anything else. You just got to get out of there and figure it out. So I call it hitting the ejector button, put my parachute out and landed back home here in Indianapolis. And then, to your and Alex's credit, everybody I talked to when I was talking about next career move said, you need to get in touch with Spencer and Alex. They're building something that's very cool. It's real estate, commercial real estate, apartments. I just got my broker's license to do the single family home thing. So it just kind of made a lot of sense. And then, here we are 3 years later.
Yeah. It's wild to think. And I was just thinking about this, I think, Griffin, you were, I don't know how often you would listen to, but I remember one of the first few times I remember at least meeting you in person. I'm sure maybe we had met prior, but it was at the restaurant on College. It's no longer there. It's
going to be a little creepy, but it's Blue Point Oyster.
Yeah, Blue Point.
Spot.
And you came up and you're like, hey, Spencer, I listened to the podcast. Like the podcast. And I think that may have been one of the first times ever someone like in
That's
the
awesome.
public had been like, hey, oh, I've listened to the podcast. And so I was like, this is a little crazy. I didn't know anyone actually listened to the podcast.
Right.
But that started, I mean, eventually I think we had lunch, months later, maybe even, 6 months later. Seems like a year. I don't know. Time's all kind of compressed through that period of time. And you started on not even an internship. I think you started just shadowing for a couple of days because I was like, at the time, I'm like, yeah, Griffin seems like a nice guy. He's doing the single family home thing. It was clear that you were actively trying to figure it out. You were trying to carve a path, and everything from the single family brokerage side. You were also looking at deals. I remember you were looking at some deal that was like kind of like it was like a motel and room to build like a duplex, and it said you were like, I think we can make this work. It sounded like not like the craziest.
It had a lot of moving parts.
It had a lot of moving parts. I'm like, oh, Griffin, I don't know about this.
The guy that bought it got a great deal, and I think he's doing well. So
good. I'm sure.
also doing
good
well,
for him.
So no big deal. But yeah, I was definitely trying to figure it out. I think the idea of, and if there's anybody out there that listens to this that got this far on the podcast, thank you.
Yeah.
Second of all, anybody that's thinking about pivoting, happy to have that conversation. I put that out there on LinkedIn. I got a lot of responses from that. Had a few virtual conversations with other professionals, primarily folks in the medical space that are thinking about maybe leaving.
Were you surprised how well that resonated?
I really was, and I think there's a lot of people in a season of change, or looking for a season of change in their careers, where for whatever reason, I'm happy to have that conversation. But walking into Gray Capital on my shadow days, I think I had 3 shadow days. The first day I came fully in a suit, which. This is my first corporate environment. I came from a locker room. We would wear T-shirts and gym shorts to work every day. So I just still kind of getting used to
figuring it out.
Corporate America,
aren't we all?
Private America. I would say just the best thing that I think that I did walking in here was just being a yes man, essentially just being willing to do whatever needed to be done. I think the first few months I was here, I was working with our director of property management at that time. We were going through paper rent rolls at Crosswinds, and I was doing a rent roll audit on physical paper and then scanning it in and making it a part of our electronic system. That was really brutal. That was zero fun, sir. And got through that and
didn't complain.
Still here. I think the idea is, just being,
throw it at me.
I learned something that day. I got to see what a rent roll looked like.
Yeah.
And I got to understand how important it is to maintain and have that record, for disposition or at acquisition when we do due diligence. And anything that you can get involved in and at an early day in a new career path, you should learn something. So, and I'm still learning. We're putting the newsletter together for the first time the last 2 weeks. That's been a major learning experience.
Yeah. But again, same thing with scanning in the rent roll, no complaints, jumping in, all right, let's do it. What does it take?
Right.
And you've become, incredible, core player and team member here at Gray Capital, from how we treat investors, the feedback that we get from, current prospective investors to the accuracy and the delivery of reports, doing a lot of things. We're a growing company, going to be 70 plus employees here very soon.
That's exciting.
But we're also kind of relatively small core group also, especially here at the corporate office. So thanks for all you do, Griffin.
You're welcome. Thanks for the opportunity. There's a lot of people wearing a lot of hats. I think there's nobody that wears more hats than Spencer. So it's a pleasure to work for somebody that never will ask you to do something that he or her wouldn't do themselves. My past career path, there was a lot of that going on. So I haven't done anything here at Gray Capital that you wouldn't have done or currently do.
Yeah.
Makes it easy.
Appreciate that. Yeah. Trying to make it work for everybody. We're all moving in the same direction.
We are. Common goal.
Cool.
It's good stuff.
Awesome. Griffin, thanks for coming on this episode of the Gray Report. Going to have to come back on again, especially now that you're helping to put together these newsletters. You're going to be, again, anybody's got a question about the multifamily market, macro economy. Griffin is already an expert, but is going to be able to teach a masterclass here very, very shortly. Sign up for that newsletter. Again, graycapitalllc.com/newsletter. And as Griffin said, if you're at this point in the podcast, we thank you so much for being a long haul viewer or listener. Make sure you're subscribed to the YouTube channel. And also, you can catch this on Spotify, wherever you get your podcasts. We try to make it as convenient as possible. And yeah, if you're an accredited investor, hop on, get access to our investment portal, graycapitalllc.com. There's buttons, click them, sign up. You can even schedule a meeting directly with Griffin. He'd love to have a conversation with you. All right. Thanks for watching this episode of the Gray Report. Catch you next week.